Hello friends and welcome again. In this video, I will talk about investing mistakes that you need to avoid at all cost. Now, why did I think this topic is worthy of making a video? The reason is Morgan Housel. Yes, the author of book Psychology of Money. So he has a quote which I want to read out because I don't want to misquote him, which says that good investing is not about making great decisions. So it's not about like you investing into something which is really out of the blue or will give you mega returns. It's about consistently not screwing up. So you just need to avoid mistakes, avoid screwing up. As long as you stay invested and avoid screw ups, you are good. You will end up rich. It is not about being the smartest person in the world. It's not about making the great moves, like being smart and intelligent, being Warren Buffett and making great moves, investing in here, investing there, moving your money across different futures, derivatives. No, none of that. It's about consistently being pretty good at not making catastrophic errors. I think that makes investing quite a bit easier. It's intimidating if you think you need to be a genius and make a great move. It's much more accessible if you think that all you need to do well is avoid mistakes over time. So what he's trying to say is that you just need to avoid mistakes. As long as you can avoid mistakes, you will end up being rich. Now, I am a living example of that, which is I was able to make or amass wealth of $1 million in my early 30s. And that was only because I took an investing strategy whereby I decided to avoid all mistakes. I did make some errors earlier on, but soon it was me realizing that these errors I need to avoid. And as long as I can avoid these errors and mistakes, I will end up rich. And let me tell you one more thing. The hardest part is making your first $1 million, which I was able to make in my early 30s. Once you've made your first $1 million, the second million, the third million is very easy. You kind of double your money every 7 years, even if you don't touch it. Like you have $1 million invested, in 7 to 10 years, it doubles to 2 million. You have 2 million invested, in 7 to 10 years, it doubles to 4 million, and so on and so forth. It keeps doubling. Even though if you don't invest another dime in your portfolio, you just sit with that 1 million and invest it, it will keep doubling every 7 to 10 years. This is the historical returns that the stock market, primarily S&P 500, has been providing. Now, one call out before we move forward. In case you find any value from this video, I have to ask for you. One, press the like button as this keeps me motivated. Second, press the subscribe button along with the bell icon so you get notified as soon as I put a new content on this channel. On this channel, I post content pertaining to financial and career success for early and mid-career professionals. Also, if you want me to continue making unbiased content like this, you can support me on patreon.com. I will leave the link to my Patreon page in the description of this video. Now let's get rolling back into the video. Now, let's get into the mistakes that I avoided and you should avoid at all costs. Number one, do not pick single stocks. Now, it may be tempting to pick Apple. Apple is a good stock. I really like it. Microsoft, great stock. Procter & Gamble, I worked for Procter & Gamble for 11 years. Great stock. But do not pick single stocks. Do not waste your time in doing any technical analysis. Oh, this stock went down 20%, so it will go up 20%. It will go back to its base price and hence I should buy it. It will go up. Don't do that. The reason is because you don't know about that particular company. You've not read their annual reports. You don't know their management. You don't know their strategy, their future plans. These people like Ray Dalio, Warren Buffett, they are talking to the management of the companies in which they are investing. They are on their board. They are talking to them. They are even part of devising their strategy. That is why they go and pick companies and buy stocks. For an individual or average investor like me and you, we have a lot of other things going on. We have our 9-to-5 job, we have our family, hobbies, other things as well. We don't have time to go investigate a particular company, read their annual reports and know everything about them. So instead of finding a needle in the haystack, just buy the entire haystack, which is instead of picking one stock, buy a portfolio of stocks. What I mean here is simply buying an index fund or an ETF, which is a portfolio of different companies, and simply that way you get diversified. You're not invested in one company, rather you're diversified. As long as you're diversified, you are holding an ETF, that is fine. A company may go up, may stay in the ETF, may go down. It doesn't matter. It won't hurt you because the ETF will continue to grow. And the best ETF that I invest in, or where I have most of my investments, is S&P 500. So pick an ETF of S&P 500 and just invest in it. Another good thing about the ETF is it is very low cost. instead of going for mutual funds, which are higher in cost, the fee or the maintenance fee for ETFs are very, very, very low. So the fees will not be eating from your returns. You will be earning pure returns from those ETFs. Plus, you don't have to worry about picking one stock. You just buy the haystack, because it has happened. The S&P 500, 20 to 30 years ago, the big companies were Enron, GE, Exxon, so on and so forth. However, now the big companies are Apple, Google, all the tech companies. And this may change again in next 10 to 15 years. So don't try to predict what will be the next big company that will make it or break it. As against that, just buy the ETF, buy the portfolio, so you remain diversified. This will continue to go up. The market has been going up 7 to 10% historically in past 40 to 50 years. It will continue to perform well. If not 10%, at least 7%. It will continue to grow, as we can see from the history. So just buy an ETF. Second mistake to avoid is don't invest in something that you don't understand. And here's something that I don't understand, at least from investment point of view or value point of view, is Bitcoin. I understand the technology. I understand how the technology is being used and applied. But from investment or from hold or value point of view, I just don't get it. If I don't get it, I don't invest in it. So if you don't understand anything, even if there are people on TikTok, on Instagram, talking about it and telling you to buy stuff, just don't do it. Keep it very simple, as I say. Your investment strategy should be boring and simple. As long as it's boring and simple, you will end up rich. If ever you try to become more adventurous with your investments, that is when you will make some money and you will lose more money. So don't invest in anything that you don't understand. If you don't understand futures, you don't understand derivatives, you don't understand options, just don't do it. Keep it very simple for yourself. As I've said before, your primary job is 9 to 5 in the morning, your family, your hobbies, and maybe some side hustle as well. Investing, just keep it very simple and keep it something that you understand, and that is an ETF for the market. That's all. Third is avoid investing through real estate. I don't recommend investing through real estate. Rather, invest through stock market. With real estate, there are so many hidden costs that you have no idea of. The cost of the agent, the cost of maintenance, the cost of house not going on rent, the cost of a bad tenant. The risk profile with the rental property, with investment property, is very, very high. Plus the costs are very, very high. There are lawyer fees, there are other taxations as well which are involved. For instance, you have to pay property taxes no matter whether your property is rented out or not rented out. That is a cost that is going every year. Similarly with stocks, the cost of investment is very small. The management fees are very, very small. Plus you easily get 7 to 8% or 10% return. Why at times real estate looks attractive is because there is someone in your family who will come and sit on the dinner table or on a family meetup and will talk about a property that was sold in your neighborhood, or your neighbor will talk about a property that they sold or they heard someone selling in the neighborhood and it sold for such a great price. These are just one-off events. It's just like picking a particular stock. So you pick a particular property in a particular area and it does well, but there is a good chance it can do bad as well because of any other thing in the market, in the industry or in the economy. So avoid that. The only reason or only time when property does good returns is because of leverage, because you pay 20% down payment and then there is 80% of mortgage. So your returns are on that 20% down payment and hence those returns look good. But this brings in an extra risk element, which is mortgage, which is debt. Now, I made a separate video where I talk about investment between stocks and property. So in case you want detailed understanding and you're not still convinced, I recommend you check out that video. I will leave the link here, also in the description of this video. Now, talking about leverage and debt, because I said in property, the only way you can get good returns is because of leverage and debt. And this is my next point. The mistake to avoid is going into debt or leveraging yourself or over leveraging yourself. There is some debt which is good and it is good debt, but you should also remember that you should not be highly leveraged. Like the amount of leverage you should have should be something which is manageable. Like if at any given point in time, the interest rates, like they are going up now, goes up, you should have enough cash, enough investments to quickly pay off your debt and settle it. It's just that when the interest rates are low, maybe it's advisable to pick up some debt for maybe your house mortgage or any other business investment that you've done, but make sure that you are not reliant on that debt alone. Like at any given point in time, the bank says, I want my money back. You should have enough money to pay them back. You're just holding debt because it is good cost of capital, the interest rates are low, and hence it is better to invest. and you have some other investments in your stock as well. So this was the case with me as well. With my mortgage, I knew at any given point in time, if the interest rates start to climb or my mortgage has been called by my bank, I have enough investment to pay most of my mortgage down. And hence I was comfortable taking a bigger mortgage because I knew I have investments and cash with me, which at any point in time, if I want, I can pay most of my mortgage down and hence reduce my level of risk. So avoid debt, avoid leverage as much as possible. There is good debt, there is good leverage. I will make separate videos on talking about what do I mean by good debt, good leverage. However, make sure at any given point in time, the size of the debt and leverage is something which is manageable. Like if you want to pay it off today, you can pay off like 80 to 90% of your debt easily. Only in that case, it makes sense to have some debt just because you're getting good returns out of it. Other than that, it just doesn't make sense. Last but not the least, the mistake to avoid is not to time the market. Rather, it is not about the timing of the market, it's about time in the market. So what I mean by timing the market is when you think the market is down, maybe you buy. When you think market is going up, you sell, and then you buy, you sell, and buy, sell. Now, usually what happens based on human psychology, when the market starts to go down, this is when you get scared and you want to sell off. And that's when you sell. And when the market starts to go up, you start buying because you think everything is looking good. So at low, you buy, at high, you sell. When you do this, you lose money. I made a separate video where I talk about daily average costing, which is that you buy stocks on daily basis or maybe on weekly basis, on regular basis, and keep buying them. There will be moments when the market is down, so you buy cheap. There will be moments when the market is up, so you buy expensive. But on average, since the market keeps going up, you will make good returns. As I said, I've made a separate video where I talk about why daily cost averaging is a far better strategy in terms of return, historically proven by numbers versus any other strategy which goes about timing the market. Check out that video in case you're still not convinced and you want to see the numbers. I use historical data of S&P 500 to make my case. Thank you for watching this video. Hopefully after watching this video, you are convinced that these are the 5 mistakes that you need to avoid at all cost. Thanks to Morgan Housel, who tells us that the best way of getting rich is just to avoid mistakes. If you avoid these mistakes, you are good. You will succeed in the market and you will get rich and wealthy. In case you found this video helpful, I have another video where I talk about my financial freedom journey. Maybe you can take some inspiration from that. You can check it out here. Other than that, I have another video where I talk about how you can go about investing in the stock market. You can check out that video here. Thank you.